Hi, welcome. Thank you, Jörn, for the introduction, and a very warm welcome to everyone on the call. I will explain what the EU is working on when it comes to sustainable finance regulations, what this means for financial institutions and corporates, and how this relates to data. But before I go into the topic, let me talk a little about SIX and who SIX is. SIX is the operator of the Swiss exchange, which includes trading and settlement services as an example. At SIX, we also offer banking services, which includes interbank clearing and ATM services, amongst others. And we have a financial information business, and this is the business unit I am part of. A few highlights. We are owned and governed by 122 international financial institutions. We have 90 years of expertise with providing data. Last year, we acquired the Spanish stock exchange, BME, to create the third largest European exchange. We also have SDX, an integrated issuance, trading, settlement, and custody infrastructure for digital assets. And we're the official SARON administrator for the Swiss National Bank. We're also an operator of the ANA Service Bureau, and we've won many awards in the past. We've won the Best Corporate Actions Provider Award from Waters Technology for 11 consecutive years. And we provide data on more than 70 regulations worldwide. Fighting climate change is one of the most important goals on the global political agenda. The EU is taking a leading role in developing regulations to achieve that goal. These regulations will affect all financial market participants. From a European perspective, it would be convenient if other jurisdictions use the same framework and taxonomy, but this remains to be seen and will develop. I'm talking about the EU Action Plan on Sustainable Finance today. This is based on the 2015 Paris Agreement on Climate Change and on the UN 2030 Agenda for Sustainable Development. The EU Action Plan has three main goals. The first one is to reorient capital flows towards sustainable investment in order to achieve sustainable and inclusive growth. It's widely accepted today that the financial industry can make a difference by allocating capital to more sustainable companies and projects. The second goal is to manage financial risks that are stemming from climate change, other environmental and social issues. Every company on this planet is affected by the changes that are happening on the environmental side. And it's crucial to address those changes and those risks as part of the strategy and make sure this is considered in business decisions. And the third goal is to foster transparency and long-termism in financial and economic activity. And that's really where the data aspect comes in. There are a total of 28 regulatory initiatives under the EU Action Plan. Some are relevant for the financial sector and others are not. The ones that do affect the financial sector, out of those, I will talk about two. That's the Taxonomy regulation and the SFDR, which is Sustainable Finance Disclosure Regulation. And I'm focusing now on these two for the rest of the presentation. So those two regulations will have a very big impact on financial market participants in Europe and beyond, actually, and they will result in more transparent disclosure of sustainability metrics. But also it means that data and high quality data will be needed, which has to be used in the back, middle, and front office of financial institutions. As SIX, we act as a data hub by aggregating data from different sources and delivering this data to our clients via one of our established delivery capabilities, such as our feed, a flat file delivery, or API. SIX has long-lasting expertise and an excellent reputation in implementing regulatory data. Two examples are MiFID II and PRIP, but as you've seen, there are many, many others. Of course, there are also challenges. This is not an easy task, especially as there is lots of time pressure with a short implementation time. SFDR, the first level of the regulation, already applies. It started to apply from the 10th of March 21. And it will be a phased-in approach with more and more requirements becoming effective as we go on. And the EU taxonomy starts to become applicable with the first requirements from the 1st of January 22. At the same time, the regulations are not yet fully defined, so there's still a moving target, which of course, together with the time pressure, makes this even more challenging. And then last but not least, the data sourcing this data from corporates, the so-called investee companies under the regulation, and manufacturers of financial products. This is not an easy task, as there are many actors in this, and a lot of the data is not yet available. Affected by the regulation are corporates and financial service providers. On the corporate side, we have a difference between the taxonomy regulation and the SFDR regulation. For the taxonomy, large companies that are required to report under the non-financial reporting directive, they will have to disclose according to the EU taxonomy. So they do fall under the taxonomy regulation. Now, with the SFDR, this is slightly different, as the investee companies themselves do not fall under the regulation. So they don't have to disclose information. But we are convinced that if they want to remain attractive as issuers of equity and debt instruments in the financial markets, it's in the best interest of companies to make detailed ESG disclosures that can then be used by the financial service providers to make their disclosures to the market. Now, for the financial service providers, it's a variety of institutions that fall under both regulations. It's investment advisors, manufacturers of financial products, institutional investors, asset managers, but also the insurance sector and index providers. And in terms of geography, it's not only financial institutions that are headquartered in a EU member state, but it's actually also institutions with branches or subsidiaries in the EU, or even only with a client relationship in the EU. It's also any institution that manages an EU-based product. So, for example, an asset manager managing a Luxembourg incorporated fund falls under the regulation. So these regulations will have a huge impact on almost all financial market participants in Europe and beyond. In terms of SFDR data flow, on the left-hand side of this picture, we see the investee companies. So these are the companies that are issuing equity or debt instruments. As I mentioned before, for them, it's not mandatory to disclose under SFDR. However, the manufacturers of financial products and the investment firms on the right-hand side, they will require this data from the investee companies to make their disclosures. Disclosures are mandatory for product manufacturers with 500 and more employees. There is a compliance comply or explain principle for smaller product manufacturers and investment firms. This means they can also issue a statement that the adverse impacts of investment decisions on sustainability factors are not considered and the reasons therefore. However, if they issue or sell any ESG-focused products, they will have to comply and make detailed disclosures on entity and product level. And the ESG-focused products are defined as products with environmental or social characteristics or sustainable investments. So the manufacturer will make disclosures on entity and on product level. And as you can see, the data provided by the investee companies is key for these financial service providers to make their disclosures. As without the reported data from the investee companies, the disclosures for the financial firms is very hard. It has to be based on estimated data, which is, of course, not ideal. So important to note is that there will be two levels of data, if you wish. So one is the investee company data, which we are sourcing and providing to manufacturers and investment firms. And that's the blue arrows, numbers 1 and 2 in this picture. And then the second level of data is the product manufacturer data. That's mainly coming from fund managers, which we source directly. We already have relationships with more than 600 asset management groups today from which we source data. So this data is sourced from the manufacturers and provided to the investment firms who sell those products to their clients. And that's the red arrows in the pictures, number 3 and 4. So here an example what this means for a fund manager. So the fund manager will, at entity level, report on adverse sustainability impacts. This has to be done on the website. And then on product level, for the ESG-focused products, and they're defined as either products which promote environmental or social characteristics. They're so-called SFDR Article 8 or light green products, or products with sustainable investment or a reduction in carbon emissions as an objective. And these are the SFDR Article 9 products or dark green products. And for those financial products, the disclosures have to be done on the website in pre-contractual documents, for example, a prospectus, but then also in periodic disclosures in a UCITS kit, for example. So what does this mean at SIX? There was the final report on the draft regulatory technical standards was just issued on the 2nd of February this year, and it defines in total 64 data attributes. And this data will need to be sourced from investee companies and manufacturers of financial products. For the financial institutions, not all the 64 indicators are mandatory to disclose on. There are actually 14 mandatory ones, and then according to certain rules, some others need to be reported on as well. But of course, as a data provider, it means we will have to enable distribution of all the 64 attributes. And what we're also doing is when we source this investee company data, we map it to the underlying products. So equities or bond instruments that are issued by those companies will get the same indicators, and that's for easier intake and processing, and feed to product management system, for example, or portfolio management systems at our clients. The taxonomy is a classification system for sustainable economic activities. The main difference to the previous slide is on the left-hand side of this picture, because large companies will have to disclose under the taxonomy. So they will disclose how their activities are aligned with 6 environmental objectives. And those objectives are climate change mitigation and adaptation, which will come in a first step, and then later on followed by 4 further environmental objectives on water, circular economy, pollution, and biodiversity. Otherwise, the data flow and the requirements for financial institutions is very similar to SFDR. The financial products in scope of SFDR will also be in scope of the taxonomy for disclosures. And investors will be required to disclose the proportion of underlying investments that are taxonomy aligned, and that's expressed as a percentage. The 2 regulations are interlinked. Unfortunately, SFDR comes into force before the taxonomy, as the taxonomy is amending the SFDR disclosure requirements. And just last week, a joint consultation paper was issued by the European supervisory authorities on taxonomy-related sustainability disclosures. This means that the soon-to-be finalized SFDR RTS, or regulatory technical standards, will be amended for disclosures of financial products investing in economic activities that contribute to one of the 6 environmental investment objectives that I just mentioned before. So, as you can see, this is quite complicated and needs a lot of analysis work. The SFDR regulation is also linked to other regulations, like MiFID II or UCITS, for example. Here an example of a link to MiFID II. By the end of 2021, private investors will have to be asked for their ESG preferences as part of the appropriateness and suitability assessment under MiFID II. At the moment, under the EMT version 3.0, EMT is the European MiFID template, there is an ESG preferences flag. So this indicates if a financial product is suitable for an investor with ESG preferences. Now in EMT version 3.1, this will be extended and it will become a sustainability preferences flag, and it will actually indicate if a product is an Article 8 product under SFDR or an Article 9 product under SFDR. So this is to fulfill the level 1 of some of the level 1 requirements under the SFDR regulation. We will deliver that flag from mid-April, and it will then be helpful to it will help to identify the products as according to Article 8 and 9, and therefore if they can be recommended to clients that have sustainable investment preferences. And of course, we then expect all the funds that are flagged as ESG or sustainable investments to make the detailed SFDR disclosures going forward. In terms of timeline, level 1 of the SFDR regulation already applies since the 10th of March. This is entity level and product level website and pre-contractual disclosures. This is still high level, and really the institution needs to talk about how it addresses these ESG requirements in a broad sense. From the 1st of January 2022, the Level 2 regulation will enter into force, And that means the principal adverse impact indicator, so the 64 that I mentioned, will have to be published at entity level and at product level for Article 8 and 9 products. More detailed disclosures in documents and therefore periodic disclosure documents will become necessary. Now, the real disclosure only happens in the first half of 23. So the regulation becomes available for 22, but the disclosure for 22 happens in the first half of 2023, because all the disclosures will always happen in the first half of the following year until the 30th of June each year. And then there will be another requirement which will come into force on the 30th of December 22, and that's the adverse impact at product level disclosures. In terms of the sixth timeline, I mentioned before, by mid-April, we will deliver this sustainability preferences flag, which will be under our MiFID II investor protection data service. And then in July, we will be ready for the delivery of the detailed SFDR data. And that will be delivered via VDF, which is our feed product, also 6Flex, which is file delivery, and then a bit later an API delivery as well. On the taxonomy, there is a bit more time, but not that much. And the requirements are hugely complex with the regulatory technical standards not yet published. So the first application will be from 1st of January 22 with the disclosure requirements for climate-related objectives. So climate change adaptation and climate change mitigation. Followed a year later by the application of disclosure requirements for other environmental objectives. On the sixth timeline, again, we will be ready for data distribution from November 2021 via the same delivery channels that I mentioned before. Now, the difficulty here is really that a lot of the data is not yet available. That applies to SFDR and taxonomy, and it will take some time until the data is actually coming in and can be delivered. So the main takeaways, these regulations will have a huge impact on financial services firms and corporates, and over time will lead to wider and deeper ESG disclosures, as this is all about transparency. At the moment, though, the availability of the relevant data is a huge challenge and will need to develop gradually over the coming months and years.
Please don't hesitate to put questions on the chat, folks. We're still here. Janine, I'm not the absolute expert on this, obviously, but it seems to me that there are two very main parts of this. Is the actual corporates or the companies that need to provide the information in a proper way. And then there are very much also the investors, especially UCITS and funds that is under some regulation that needs to provide this going forward, right? Is that correct?
That is correct. And on the financial institution side, it's the manufacturers of financial products, like the funds managers you mentioned, but also investment management firms. So the same firms that fall under the MiFID II regulation will also fall under these regulations.
And as I'm very much involved with the investment funds or the UCITS funds, so those who are in that part of it, we have a supervisor community. We have supervisors looking that everything is done accordingly. The corporates or the companies, they are not under that type of supervision. So if the information is not provided, who's going to be sort of pushing? Is there a sort of a supervisory body that will drive the corporates, or how will that work to provide the correct information?
Yeah, and I think that's a very good question, because this is one of the big challenges of this. I mean, on the taxonomy, we have the big firms that fall under this. And there is the non-financial reporting directive, which is also being reviewed at the moment. So that's also something that's in flow, and we will see updates to that. But there it's basically the non-financial reporting directive that sets some requirements under the taxonomy. Now the issue is under the SFDR, because the SFDR is really a regulation for financial services firms, and it does not apply to the corporates. But I think, what the regulators intend here is really that the pressure will come from the financial services firms. The pressure will come to the companies, and over time, companies will realize that it's also in their best interest if they make those disclosures, because of course they want to raise money in the capital markets. And if they want to continue to do so and have investors from the EU, then, they better provide this information.
And the need to collect this information and get these, it doesn't matter where the company is based. It's an EU regulation, but it also involves a company in China or India or in the US or.
Exactly, that's the other big challenge here, of course, and I think exactly. So a European fund manager who is investing in a Chinese stock will also need the information on that Chinese stock to be able to make the disclosures. And I think it's quite clever actually how this is done. So again, putting the pressure from the financial services sector to the corporates on this. And yeah, that's also why, of course, not only European firms are affected, but this goes much further.